hold on a second. I only got to pay 3,000 and you don't have to pay it. Like you said, somebody else can pay it. The 3
So
grand.
it's like a magic trick in this scenario. So you're talking about, so you got a $50,000 problem that could go away with a $3,000 fee. That's pretty handy thing to know about.
Welcome back to the South Florida Mortgage Report. It's your hat dude wearing mortgage guy, Billy May, always joined by Craig Garcia, president of Capital Partners Mortgage. And Craig, between the two of us, we've got what, 50 years combined mortgage experience. We love to talk about mortgages. We love to talk about real estate, right?
That's it.
Yeah, yeah. And we had I was out last week. You had a great conversation with a local appraiser who's been on for forever. His name is Phil Biber, and we're going to talk about kind of something related to that today, right?
Today, we are going to talk about what you can do when you get a low appraisal. We're going to go deep into that topic, and then we're going to actually give you a tool that you can go and use today if you are on any side of a transaction and you're curious about, hey, we have a low appraisal. We want to keep this transaction together. Maybe the appraisal is the only thing standing in the way. And maybe this is going to tell you about some options that you may not have thought about. Maybe, and hopefully you'll be thinking about a low appraisal a little differently after you listen to this.
So Craig, so let's fire away. And I know we've utilized this tool before, but now you're actually going to show us how this tool works. And if you have an appraisal issue, and that's like you said, if something's holding up, getting a deal done,
Yeah.
how can this work?
So we had a great conversation last week on appraisals with Phil Biber, a 36-year appraiser down here in South Florida. I'd encourage you to check that out. He talks about how to deal with appraisers. I was looking up some statistics. It said maybe 10% nationally of appraisals come in short on purchase transactions. And Florida is usually high on the list. So usually, if that's the national average, Florida's probably higher for whatever reason. So it's not something that you run into every day if you're in the business, but it certainly can happen. And what we're talking today about is the appraisal comes in low, and now you're involved in the transaction, and you want to keep the transaction together, but you get a cash gap to solve. And I honestly, I would say there's a lot of misconceptions about what it means when the appraisal comes in low. Okay. And we're going to talk
Yes.
about some of those misconceptions and then what you can do. And again, we've got a tool now that's live on our website that you will be able to use after listening to this to play around and see what it means and what we're talking about and how to think about this a little differently. So anyway, so let's get into it. So
Yeah.
this first one I want to talk about because I see people do this. I see people who are in the business, real estate agents, mortgage people. There's a $500,000 purchase price. And this is so the first scenario is a big down payment, okay? Like an oversized down payment with an appraisal that comes in low. So you have a $500,000 purchase price. Borrower is getting a $300,000 loan, right? And so, uh, and now the appraisal comes in $10,000 short. So now instead of a $500,000 purchase price, you've got a 490 appraisal. And I've literally had people think, "Oh wow, I have to come up with an extra $10,000 now." Right?
Yeah.
I mean, is that really the case?
No, no, no. Our just loan to value changes, and that with the down payment that big, it's a number at that point.
Yes. Now let's put it this way: we are assuming in this case that listen, the buyer, in this case, the buyer who was interested in paying 500,000, they were interested in the loan that was the loan payment at $300,000. And so the idea that, okay, now they have a 490 appraisal, that it automatically means that now you can't get a $300,000 loan. You have to ratchet that down too. It's just not, it's just not the case.
No.
So there's nothing that to Bill's point, the only thing that really happened in that deal assuming the buyer wanted to proceed. Now, the buyer may say, "Hey, listen, this didn't appraise at 490, and or it didn't appraise at 500, I should say. So I don't want to pay 500. I want to pay 490. And if they've got if they've written that right into their contract to go back and renegotiate it, they can do that.
Yeah.
And certainly that's an option. But the idea that they have to come up with extra money is definitely not the case unless for some reason the only program that they were getting, the loan that they were applying for, required a $200,000 down payment on a $500,000 property. It's probably not the case.
Yeah,
I
probably
would
not.
most of
Yeah.
the time. That's a huge, huge down payment. There are some cases, some certain types of specialty loans and stuff like that. Maybe that would be the case, but most of the time it's not. But there's this perception that this is extra money out of pocket. When meanwhile, hey, and the other way to look at it is, okay, the buyer and seller agreed that the value of the property was $500,000. The appraiser and the buyer agreed, okay, I'm going to put $200,000 down. I'm going to get whatever the payment was going to be, $3,000 for a monthly payment. And that's what I'm comfortable with. The fact that the appraisal is 490 doesn't have to change the $200,000 down, and it's very likely not going to change the $3,000 a month payment. Nothing has to change, and they can just move forward. There isn't
Yeah. I mean,
extra
the only thing
money out of
changes
pocket.
is, yeah, we go from what to 62 LTV to what 65 LTV or so. I don't know. I'm just throwing some numbers
Yeah,
out there,
yeah.
right?
Your LTV went up a little bit, but nothing that materially changes the transaction for the buyer or the seller if they both want to move forward on the deal. And so, but I have seen deals get really messed up because now they think they have this problem when it's really
Yeah.
not a problem. So anyway, so big down payment. Um, it's not really probably an issue unless you would like to make it one, unless you want to use it as a negotiating tool, which you're entitled to do. So that would be one thing. The big down payment scenario. I miss anything on the big down payment scenario, Bill?
No, not really. I mean, usually from my past experience, whenever I've had that happen, it's really not that big of a deal. I mean, any professional realtor, you get to their buyer, and the buyer more than likely usually just pays it. Will pay the 500. So they might negotiate a couple of $1,000s or something, but I'd say statistically speaking, most of the time they'll just agree to it because they're putting such a down payment. They've already done the research. It doesn't really affect anything.
Yeah.
It's not a big deal. Yeah. The problem, Craig, as I'm sure you're probably going to launch into now, is if you have a $500,000 sales price and somebody's putting 20% down, which is 100,000, and now you got a $400,000 loan, and now you come in at 490, now they could have an issue.
So that's the next scenario, right? And that's this is the one that has the most kind of opportunity for people to understand that there's more options in their thinking. So yeah, let's use your example. So $400,000 property, they're going to put, or excuse me, $500,000 property. Let's go there with a $400,000 loan. So they're putting down 20%. They don't want PMI. And now let's use the example of the property is going to appraise for 450, right?
Ooh, it's a
It's a
big
big
one.
one. It's a big difference. That's a big difference. But I'm
Yeah.
going to use that example because there's an illustration that I think is really helpful to understand how powerful the concept of what we're going to talk about is. So so now you have a buyer. They agreed to a $500,000 price, a $400,000 loan, and a payment of, let's just call it $4,000, just for simplicity.
Sure.
So, and now though, the appraisal came in at 450. Okay. Which now means you got a 450 purchase price, or excuse me, a 450 value and a $400,000 loan amount. And let's just assume that the buyer wants this property, right? And
Right.
it's got everything that they need. The reason that they might want to do that maybe is, and we've seen people do this. Just to be clear, and we're not advocating that somebody should do this, but there could be reasons. I mean, you could have a property in a neighborhood, and this property's been upgraded in all the ways that this particular buyer would have done to another property had they bought it, but it's already in the shape that they want it. They've
Right.
already done all these maxed out upgrades. And
Right.
so to them, and there's nothing else that they can buy where they wouldn't have to go in and put a bunch of extra money in property to kind of fix it up that way. So if they could get this one at that price, the appraisal is limited by what the comps can show, and the data that the appraiser can use in the marketplace. See
Yeah.
last week's episode.
Yeah, yeah. Could
But
it could be like you said, the place is maxed out. Maybe it's got an unbelievable pool. Maybe it's got windows. The inside's amazing. And the view is amazing. Whatever the reason.
could be a reason. Anyway, but assuming that the buyer wanted to do it, So here's the now what they're but now they go, okay, so now the buyer has a real situation where they're going, okay, so now I have to put 20% down on 450. That's 90,000. And if the seller says, hey, listen, I've already done all this stuff, I'm not taking any less for the property. Now you're talking about 90,000 plus the 50. That now you're really talking about extra cash. That's what and that's what the default answer everybody thinking is, okay, either I have to put down the extra $50,000 in cash plus the $90,000 20% down. But there is another way to look at it, which is kind of what we were alluding to before, but this will make more sense and it'll be more impactful. So assume you keep that loan the same, right? So that $400,000 loan that we were talking about, and then you've got the 450 value. So now your loan to value is going to be it's about 90% ish. Okay.
Yeah.
So you can still get assuming you qualify, you can still get a 90% loan, right? And from a standpoint of making the deal work, in other words, from the buyer's standpoint, hey, I wanted to pay 500, I wanted to borrow 400, and I wanted a $4,000 payment. Now, when the value comes down to 450, what's going to change? They could still pay 500, get a $400,000 loan, but now that payment's not going to be 4,000 anymore because they have mortgage insurance.
Right.
And now the mortgage insurance is going to add a few $100s onto the loan, and now it's not the same, it's not as attractive. And so they go, okay, so the only way to make it really what I wanted, I got to put extra money down. And I got to come up with something out of pocket, even if it's not the full $50,000 to get the payment back down there. But they look at it, hey, you got a $50,000 bridge to cross. But what people don't realize is, okay, if you use this little tool, which is called single premium mortgage insurance, you could take that payment that the guy now was looking at maybe paying $4,300 instead of 4,000, and a fee could be paid upfront by anybody in the transaction. And now that payment is the same as it was before. So now you eliminate the PMI, right? So now he's paying 500, which he wants. He still
Right.
wanted to borrow 400, and he could
Right.
still get the $4,000 payment in
Right.
spite of the fact that the property value appraised at 450, and that fee can be as low on that $50,000 problem, right? That fee to get the buyer the same payment and the same down payment can be $3,000.
Yeah. Yeah. So people are like, well, hold on a second. I only got to pay 3,000 and you don't have to pay it. Like you said, somebody else can pay it. The 3
So
grand.
it's like a magic trick.
Yeah. Yeah.
In this scenario. So you're talking about, so you got a $50,000 problem that could go away with a $3,000 fee. That's pretty handy thing to know about,
Yes.
because if you're that buyer and you really want the property and the seller's really bent on not giving an inch, certainly not giving 50,000 inches, but the seller would agree to pay $3,000 in a fee to help you buy out your MI, then you just got the same deal that you walked in wanting on that property. Pay 500, borrow 400, have a $4,000 payment. And all it took was the seller paying the fee to buy out the mortgage insurance on that deal. So it's called single premium mortgage insurance. That's what it is. It's a tool. So again, $50,000 problem could be solved with $3,000. Okay. Now, this is where the tool that we built starts to come in play, because what I just described, you got you have a $500,000 property and a $400,000 loan, and then the appraisal comes in at 450. We have to calculate, hey, here's what it's going to cost to buy out that MI, so that the buyer's deal is basically what he was trying to get into the deal with. Now, and what we've done is we've put this tool on our website. So if you go to, and we'll put the link in the notes, but if you go to cp-mtg.com and you go down in the resources section, we got a bunch of resources and tools and stuff like that agents and buyers and sellers can look at. But one of them says low appraisal, calculator, low appraisal calculator, see your options. If you click on that, I'm going to show it to you right now. So this is pretty nifty. So and this is a simplistic tool, but it is something that can help people open their mind. It is based off of somebody who's kind of the ideal candidate for to use something like this. Very good credit. Um, DTI is not super stretched, and so if you're looking at this and you go, oh, that's pretty interesting, you definitely got to talk to either the lender involved to make sure that something like this is going to be possible, what it would really cost, or you got to talk to us if we're involved in the deal or not, or we can work that out. But this gives you a quick idea. So here's what we were talking about. So let's say, and this is on our website right now, $500,000. You put that in there for agreed upon purchase price. Loan amount requested was $400,000, and appraised value. Now you're saying, okay, it came in at 450, and then it says, and then there's a button that says show options. You click that and it's going to tell you, okay, transaction at a glance, your purchase price, your appraised value. You've got a $50,000 appraisal gap. Your original LTV was 80. Now you're at 88.9 LTV, right? And then, hey, here's a solution most people didn't know about. The appraisal gap moved up, standard approach, $50,000. Seller reduces, the buyer brings the 50,000. Either way, somebody absorbs the whole amount of money. The other way, 3,040 bucks. The loan amount stays at 400,000. The purchase price can stay at 500,000. The buyer's monthly payment's really not going to be changed. And anybody that's in the transaction, the seller, the buyer, the agent, any combination, it could get split 4 ways, and it's $3,000 that to keep that deal together. So and again, it's single premium mortgage insurance. This is not like a some super new product. I mean, it's been around, but most people don't think about it like this and don't talk about it like this. That's all. But this is something we've done this for years. Um, in the situations that we would where you've got everybody who wants to keep the deal together, but the appraisal's in the way. And so, and they're trying to make the numbers work as best for everybody. The idea that you could solve a $50,000 appraisal problem with $3,000 and the buyer can get in with what they agreed to up front in terms of down payment and monthly payment. That's pretty powerful. And so you can come in here and play with this. Obviously, and it's got some information. You can call us with questions or what have you, but you can play around with this and look at different options. And it'll tell you, like the example that we talked about before, where you got $1 million purchase price and the loan amount's 400,000, and now it comes in at 950. It's going to tell you, hey, you went from a 40 LTV to a 42 LTV. And so the transaction may not need to change at all, and it's very likely not gonna make any change in the buyer's life. So, all right, so I'm gonna stop sharing now. So that's on the website. It's live now. We'll put a link in the show notes so that you have access to it. And again, it's there. And so if you find yourself in a deal at some point and now it's important, go back and take a look at it. And then, and to get a quick number, yeah, you could use that if you were a seller. Hey, somebody's coming to you, you're trying to hold your ground a little bit, and you're trying to figure out a way that maybe you can keep the buyer happy and keep them in the deal and not have it be just a dollar for dollar reduction in the sales price out of your pocket. Hey, at least hey, if it works out for them, this might be an option. You need to talk with either who's doing your loan or with us to get what the cost is for your actual situation. And yeah, the worse your credit score is, the more challenging that or the more expensive something like this is going to become. The other situation is that now let's talk about if you've got a small down payment, right? So we talked about huge down payment, and then we talked about a big down payment, 20% down. But imagine now you're talking about the minimum down, right? So this is going to be where it's the most challenge. You got the least cards to play. You can't really use this tool for that. Um, so let's say now you're back at that $500,000 property, but now let's say you're going FHA, right? So you're putting 3.5% down already, and now the property appraises at 490. Well, I got news for you. I don't have a mortgage insurance trick to help you in that scenario. There is one conversation that can be had with the lending company, and sometimes it helps. It's not always available. I would say there's times where, and what this has to do is this tried and true relationship between closing costs on one side of a seesaw and interest rate and payment on the other side of the seesaw, right? And so normally the way that relationship works is, okay, you'd like a lower rate on your loan. So this is your rate. You'd like a lower rate on your loan. Well, the other side of the seesaw goes up and you're paying extra fees to buy yourself a lower rate. And then if you do it the other way, you say, okay, well, I really need lower closing costs. So I need my closing costs to be lower. And now your rate goes up. And there are times, and on certain borrowers, you might have the option of, say, you know what, before I was borrowing 96.5% of $500,000, and I was getting 6.5 for a rate, just to pull a number out of the air. So now, but what happens, and Mr. Loan Officer, if I took a higher rate because I need a credit from you to cover some of my closing costs because now I'm trying to come up with a $10,000 shortfall on the appraisal that I have to fund out of my pocket, right? I wanted to proceed with the deal. Sometimes that can generate thousands of dollars towards the deal and help it make it work. And even though you're taking a higher rate, you're actually borrowing less because the appraisal came in lower. And so maybe that payment isn't that far off from what you were looking at before. So again, there are times where this works fairly well to help you with some amount of money. There are times where, depending on the situation and the loan and the market, sometimes there are just times where the mortgage market is not there. The credits for increasing the rate are less available than at other times. But it's a conversation worth having if you've exhausted all the other things, which is, hey, did you try to do a reconsideration on the value? That you asked the seller to lower the price. They didn't want to. And now you're saying, okay, well, how can I figure out a way to make this deal work? That's the last card you have to play. In that situation where you're already getting max financing, you could have gone in not thinking about using the down payment assistance programs because you had enough money to do the deal, and now suddenly you got an appraisal issue, and now you want to do that. You could circle back and see if the down payment assistance option helps you bridge the gap. It certainly is an option. Matter of fact, and just to circle back, so we had that example that we used before was the $50,000 appraisal gap, and it got solved with the $3,000, and anybody could pay for it. There is an option where you can finance it, and so what happens is the borrower, if nobody else would pay it, and the borrower didn't really want to pay it out of pocket, they could actually just roll it into the loan. Now, and if they do that, that payment that they were at $4,000, it's going to go up very slightly. I mean, you don't have MI. It's not like you're paying hundreds of dollars more. You might pay $21 more in the payment because now you're financed an extra $3,000 in there. So it's amazing how many different ways you could carve that up and look at it. So, but the idea that that is an option to try to keep a deal together. I got a friend of mine. He's been a long time, very successful real estate investor. He's always of the mind that when you have a deal, you try to keep it together. The idea that you just let the deal go and you'll find another buyer, that's never been his mindset. Stuff like this is good to understand what the options are before a deal gets pushed to the wayside, and you hope the next transaction goes a little bit better. So, to my knowledge, Bill, this is the only tool like this in the marketplace. Okay. So it's live now, and we hope you use it. And you don't have to sign in, you don't have to log in. It's just there. Just go and use it. So anyway, and if you do use it and you think it's good, or you think there's a problem with it or anything like that, I would love to get your comments and let me know, because we can tweak it and do whatever we want with it. So anyway, it's a simple tool, but I thought it's helpful. It's certainly helpful for illustrations to take a look at what some options might be on a deal. Thank you for watching and listening to the South Florida Mortgage Report, brought to you by Capital Partners Mortgage Services.